So the first thing we want to do is we want to show you how we are viewing the stocks in the light of a recession, and I'm going to give you an actual example in a few minutes. The first thing we do is we know that even in a serious recession, stocks only go down so much. In other words, there's a point where stocks will bottom. Now, how do we know that? We have almost 175 to 100 years of market history. We have 38 years of our own history, and any one of those things will test you to tell you how low a stock could go, and I'm going to tell you that in a few minutes. First of all, in that time period that we're talking about, we had 5 wars: World War II, Korean, Gulf, Iraq, and Vietnam. Now, what is interesting, if you want a real example of how low stocks go in a war, you take a look at the Second World War. There was a time after Pearl Harbor when we were actually on the verge of losing World War II. The stock market went to a bottom 6 months after Pearl Harbor, and then all during the war, it went up at an average of 13%, even though it was far from certain that we were going to win that war. So at some point, even at the risk of losing a war, these stocks bottomed out and they moved up. So every stock market and every individual stock does have a bottom, and we're going to talk about that. But during that time, we have 13 recessions. So if we want to know how low stocks can go, we got 13 recessions that we did our research on, and we're going to give you those numbers. The other problem that we looked at is government debt. We had a period after World War II, 1946, where we had government debt 112% of GDP. That's about as high as it's ever gotten in this country. We are approaching that margin today. We are at 101% of GDP. The good news about that is that in that chart, as we'll show you later, we were able to work our debt down from 112% down to 26% of GDP, which is pretty amazing. And the way it was done, it's not done by cost cutting alone. You have to have growth. And we basically, after the Second War, were able to grow out of this debt. And so that was a tremendous situation, and we have the numbers on that. Then in addition to that, we can look at the tech bubble, which was the most overbloated market next to the Japanese market in 1989. It still hasn't completely recovered. The average stock dropped 76%. And then, of course, we have the 9/11. So when you take all of those events, you have a pretty good idea of how low stocks can get in any kind of environment. And I think it's fair to say that those were enormous problems, just like the one we're facing today. Now, here's the statistics. If you take the private market value of any company, any major company, and the private market value is a simple formula which says the average price where sophisticated buyers and sellers buy a company. If I'm the seller of a company, I want the highest possible price. I got my lawyers, my accountants, my consultants, everybody rooting for me. On the opposite side is the buyer. He's got his consultants, advisors, and everybody. He wants to get the lowest price. The price where that exchanges is what we call private market value, because that's where sophisticated buyers and sellers sell. Now, the average statistic that I've kept for 38 years is about 22 times earnings. Now, you can't use that on every company. Some companies sell at 30 times earnings, and some would sell at 15. But the average is about 22 times earnings. So, we know that no matter what happens, whether it's a war, whether it's recession, whether it's high debt or whatever, 50% of private market value for major companies is a very solid price. On mid-sized companies, it's about 60% of private market value. And on your smaller companies, which Jim and Steve are going to talk to you about, it can be as much as 75% because of the illiquidity in certain of these smaller companies. It's also the opportunity. I'm going to give you a double check on that. If that doesn't resonate with you, I can give you another double check. And that is, we've studied every bear market for the past 113 years. And that means from the top to the bottom, the decline. We've had 25 bear markets since 1899. The average duration is 17 months. The average decline is 35%. And the worst decline, other than the Great Depression, was the one that we just experienced in 2009, and that was 54%. So if you want to take the private market value and you knock off 50%, you got a very good, solid situation to know that that's where it is. If you want to do the market history and do that, you're going to come up with the same number, about 35% on average, 54% for the worst case. So whether you use the private market value, the average, or the worst bear market since the Depression, 50% is a pretty good rule of thumb. Now, I'm only going to talk about one metric that we use because most of you are familiar with that, and that's the price earnings metric. It's not necessarily the best one, but it's the one that's generally used. We use 6 of them: price to earnings, price to free cash flow, price to earnings before taxes and depreciation, amortization, EBITDA, price to tangible book, enterprise value to sale, and price to sale. We're only going to use the price to earnings because of the fact that it'll be a lot easier to follow. So what we do now is we look at, okay, how low can this stock go given the situation that we're in? What would happen to the stock in a recession? How low would it go based on the ratios? And then we work that into the stock, and we're going to use one as an example for you in the future. Now, one of the things that interested me when I first got into the business, I read an article about Warren Buffett. This is about 35 years ago. And he was talking when he first got into the business, and one of the things that he wanted to know was how low can stocks go, how do they bottom, and why do they bottom, and why does the market always go up? So he was thinking about that and doing a lot of research, and he got together with his mentor, Benjamin Graham, who's the father of security analysts. Buffett attributes a lot of his knowledge to this gentleman, and I've been an avid reader and student of Benjamin Graham most of my life. And he said to him, what do you think it is that makes these markets bottom? In the worst news that you can imagine, something always turns them around. Graham thought for a moment. He kind of shrugged his shoulder, and he says, you know, I don't know. They always do. Well, when I read that, I thought, that's an interesting comment, but that didn't satisfy me. I wanted to find out why. So I spent a lot of time thinking about it, and I studied the bear markets, and I studied the different discounts and so forth, and I came to the conclusion that they all stop because of the fact that they are such a great bargain at 50% off that people from all over the world, including businessmen, institutions, and everybody, they just can't resist those bargains. And I'm going to try to give you an example of that. Let's assume you're running a corporation. You're an executive now. You're running a $100 million company. And you know, as any businessman will tell you, the big pressure from shareholders and everybody else is everybody wants to grow. So you got a $100 million company, it's doing very well, but now you want to grow. So you think, well, our investors would love for us to grow 15 to 20%. So you start thinking about how you're going to grow this company 15 to 20%. You got to hire the sales force, you got to do the advertising, you got to do the marketing, you've got to do all of these things to make this company grow. Then all of a sudden, you start adding it up and you say, geez, by the time I pay for the sales and advertising, it's about 15 to 20% out of every dollar in sale. By the time I build the manufacturing and all of the other things, I'm going to end up spending about 93 cents out of every dollar to get that extra dollar of sales. So I'm going to end up with 7% on the bottom line. Some companies only add about 5% to the bottom line. Well, that's an enormous job to take, it's an enormous risk, and you're just not sure whether you're going to end up with 7%. Then all of a sudden the market declines or an individual stock declines, and you now have the ability to pick up a dollar of sales for 45 cents. Now that's got to look pretty attractive when you think you've got to do all that work to create $20 million in sales, and in one fell swoop, you can buy that one company and you can pick it up for 45% of sales. That is such an incredible bargain that very few people can resist that. And remember, people from all over the world are looking at these bargains. It's not just United States investors, it's all over the world. If you think about the fact that we have $60 trillion in net assets in this country, and we're only 1/3 of the world, you do that times 3 times, you can see there's a lot of money to pick up these bargains. That's not the only thing. So the person goes out and buys this company at 45 cents of sales instead of 93 cents. So he immediately got a 50% off on his sales. Then he merges the two companies together, and they have a reduction in expenses, so all the profits of his company are increased by the increase in sales of both companies. But wait, it gets even better. The other thing he gets is that as this company is now growing 20% and he has the increased cross-selling between the two different companies, the multiple that people pay for that company goes up. So if this company was selling at 15 times earnings and now it's selling at 17 times earnings, he's picked up $2 a share. And if the company has 5 million shares, he's picked up $10 million just by making a successful purchase. So if we recap this situation, first of all, he's getting 93 cents of sales for 45 cents. He's getting a reduction in expenses. He's bought a $20 million company for $10 million, and now the value of the company goes up $10 million, and he's basically done this all on making that acquisition. God bless America. That's how we create wealth here. And so that is why these stocks bottom out, because they become so irresistible to somebody who has to struggle for that dollar of sales. It's cheaper to buy it. Now, let me give you one more example in the real estate market, which I'm sure all of you can relate to. Let's say we buy, the wife and you get together, and you're thinking about purchasing a home. You look at a home, you can't find the one you want, so you decide to build it. You hire an architect, you meet with builders, architect, lawyers, whatever. You spend months looking for the land, for the right design. Then you hire an interior decorator, a landscaper, and after all that work, you finally have figured out that it's going to cost you $150 a square foot for a 3,000 square foot home, which is $450,000, and you're ready to make the purchase. Then all of a sudden the real estate market drops like this one does, and that same house sells for 35% cheaper, which will save you $135,000. Now, you think to yourself, geez, I don't have to go through all this work with the architecture, with the designer, with all the thing. Here is a home that is almost exactly. It's not an identical twin, it's sort of a fraternal twin. It's not the exact picture, but it's close enough. And for $135,000 in savings, you sure are going to be able to remodel that home any way you want. So that is what creates values. When the values get to a certain level where there is such an irresistible desire to buy them, that's when real estate bottoms, and that's when stocks bottom. And in stocks, that's going to be 50%. So now let's get into our actual example of a stock, and we're going to show you how we worked that out. Our analyst, Dan Carroll, has done all the work of it. He will be available if you want to ask him questions after this program. And let's review Cisco with the recession in place and see where we are. So Cisco is, as you see in the chart, was founded in 1984 in San Jose. It has 71,000 employees, the leading provider of internet working systems for video and voice, dominant supplier to the telecommunication industry. It has $46 billion in sales, and after you deduct all the debt, it has $30 billion in cash. Now, it's got $48 billion in cash, and you take all the debt off of it, and you still end up with $30 billion. Now, here is a dominant company, a major company. It has no debt after the cash, still has $30 billion. It's just like having a paid-for home and $3 million in the bank. Are you going to worry about his credit card? I don't think so. So you are going to have a very solid company here. And in fact, we do own it in your portfolio. Now let's run it through our problem monitor. And we notice that slow growth is one of the problems that we have in this country. Well, Dan has programmed that into the company because we're only suggesting it's going to grow at 2 to 4%. Usually this company grows at 7 and even 10%. So the slow growth is factored into our analysis. The high unemployment does not directly impact this company. Now, if this was a retailer, this would be impacted dramatically. But this is a company that sells to other companies, so the high unemployment does not affect it as much as it would if you were a retailer. High national debt, that does affect it because they are selling to the government. And with the government so high in debt, they're going to have to cut their spending. So we have to consider that Cisco's sales will be impacted by the high national debt, where some other retailer may not be particularly affected by it. Dan has worked that in. Obamacare may actually be a plus. I won't go into the details, but we have not registered it as a plus. We've just put it as neutral. Military action in Iran will not have an effect on it except the temporary fluctuations of the market because a high oil price does not necessarily affect it. What does and will affect it is some of the things we talked about earlier that are not priced into the stock. That is number one, the fiscal cliff, which could send us in a recession, the bubble in China, and the European crisis. So when you boil all those things down, you're going to get into a recession. So let's take a look at how we've programmed Cisco's purchase into a recession. If you'll notice that Cisco has $2 in free cash flow, and basically that is a better number to use than earnings, but everybody's more familiar with earnings, so we're going to use earnings. It's earning $1.95. If we go into a recession, the earnings will go down to $1.45, and that is a 26% decline in the earning of that company. Now, in the last recession, the earnings went from $1.31 to $1.05, which is a 20% decline. So what we are programming in, if we run into a recession, we're programming earnings in that are 26% below what they're operating in a very slow growth environment, which is a very good test. And it's 30% less than it did in the last recession. So when you put all these things together, you know that that is we've pretty much got it covered. Now, if we take the earnings and the price, we are pricing this company at 10.3 times recession earnings. Now, if you'll keep in mind that most acquisitions like this, and Cisco is not going to be bought out because it's too big, but are 22 to 24 times earnings, you can see that 10 times earnings is a very good discount, especially since the recession earnings, they're not normalized earnings. On a normalized earnings, the earnings would be much higher. The worst case we got is 10 times recession earnings, which is $15. We're going to start buying it at 19 if we were buying it today. Fair value, that's the midpoint, is 26. The sell point is 33. And the private market value is 36. Now, we started buying this in April of last year. We bought it at $16. At that time, Dan had a worst case of $14. The stock actually dropped to 13.3, so it stayed there for a few months. Today, the stock is at $19. So if it goes to our worst case, which is the recession, Cisco will drop from $19 to $15, and that is a 21% decline. If we take our far out number, looking out 3 to 5 years, we can see this company selling for $33. That means it goes up 74%. So if you divide the 74 by the 21% risk, you get a 3.5 to 1 risk and reward. And anytime you can get a major dominant company with a clean balance sheet for 50% off, as I've demonstrated to you, that's a pretty good deal. Now look at it. The private market value of Cisco is $36. We bought it at $16, so we bought it at a 55% discount. At that price, we are factoring in all the problems we can think of today because our worst case is $15 at 10.3 times recession earnings. So when we look at your portfolio, we are saying that that particular stock, if these problems hit, and we're not certain that they will, has a risk of 21%. The reason we're still in it is because it's got an upside of 74%. So as long as that risk and reward is favorable, we're going to stay in the stock even though we may have these problems. Now I'm going to move on to my next chart, and anybody who is a market student is going to love this chart. This is absolutely my second favorite chart to look at. I have been keeping these statistics for 38 years. Every week we calculate these. We have a whole spreadsheet how it relates to interest rates. And this chart has given me a lot of peace. First of all, everybody usually follows the Dow Jones, the S&P, the NASDAQ. But all that tells you is the price. I'm not interested in the price. I want to know the value. So the price doesn't do much for me until I know the value. Well, this chart will tell you the value of the market. Because what it does is, first of all, it does something unique. First of all, it takes 1,700 companies instead of just 30 Dow Jones and 500 of the S&P. It takes the earnings 2 quarters forward and 2 quarters back, so it's not all projections. All of the other indices are always projecting, and as we all know about fortune telling, it doesn't always work. So looking back and looking forward as a compromise is a great way to go. In addition to that, they don't have just the big companies, they have a lot of mid-sized and small companies in the index. That's number 2 that makes it superior. The most important thing that is a quality of this, they use the median and not the average. Now this is very important because if you take the median price, you get a much better idea of what the average price is looking at. For example, in 2000, with the tech bubble going, we had 10 stocks that were moving the whole market. And so it totally distorted what the average stock was doing. This will never do that because they always take the midpoint. The top one could be at 100 times earnings, but it's not going to be affected because of the fact that it's the midpoint. Now, one of the great things that you'll see about this chart is that over the last 35 years, the market has moved between 10 times earnings and 20 times earnings. It's just that simple. If you wanted to know what the valuation of the market is and you had one thing to look at, you just look at this chart and it'll tell you exactly where you are. We're at about 15 times earnings, which tells you we're right in the middle. We're not in the cheapest market for sure. We're not in the most expensive market on the average stock. Now, some of the bigger stocks are getting into the high value zones. That's why we've been selling them. But for the average stock, for our purposes, we're at the midpoint. But here is the real exciting thing. As long as interest rates are below 12%, and I want you to write that down because that's crucial. As long as interest rates are below 12%, this fluctuation is going to be between 10 and 20 times earnings. And you've got 35 years of history to look at that. Now, if interest rates go higher, like they did in the early 70s, it'll go a little lower, and we'll talk about that later because that's the threat of inflation. Now, here's what's an interesting thing. Only 4 times in 35 years did it actually get to 10 times earnings. And that was, the last one was in 2009. So here you've got 35 years, and you can see how rarely it gets to 10 times earnings. So when you are at 10 times earnings, you know you're there.